So we are a good 5 months into a 300 S&P point trading range. And the way I see it, the markets are driven by two things: earnings and liquidity conditions. Earnings, of course, are booming, 24% in the first quarter, and the estimates are rock solid for the rest of the year at around 20%. But that kind of earnings growth doesn't tend to get rewarded because the market tends to not see that as sustainable, which of course it isn't, at least at the market level. 7 to 10% is more like it. But the main issue is, the Fed is tightening, financial conditions are tightening, and that's the interest rate component of valuation. And so we are approaching a late cycle environment. We may not actually be there, but we certainly seem to be heading in that direction. And we have this policy divergence between the U.S. and the ECB, so that's driving the dollar higher, that's making financial conditions tighter, and that is not a recipe for a valuation expansion, especially when you add trade to this. So it's just an environment where the market has to just sit there, and of course it was quite expensive
What's the ultimate breakout, though? Is it higher or lower, or are you waiting to see what happens with earnings? Because if the PE doesn't expand, if the E goes up, at least the market can go up.
Yeah, so basically, it's a waiting game on the Fed, right? So by 2019, the first quarter, earnings growth is expected to be back to 7%, which is its trend growth rate. If by then the Fed is nearly done with its tightening cycle, then it's all systems go. Then you have decent earnings, not great earnings, but decent earnings, easing financial conditions, and you don't have that pressure on PEs anymore. But if by next year the Fed is saying, we're not even close to being done, then I think that's a much more negative scenario, because then you lose the earnings, but you still have that pressure on liquidity conditions. So we just don't know yet, but I think for the next 6 months or so at least, we're stuck on hold here as the market grows into its valuation.
Jim, you've been a little bit on the cautious side as well, thinking the market might be capped by some of these issues. Also, I know you've been pointing out some relatively aggressive positioning within the market, the way tech is behaving, and positioning in general. A lot of other people look at that stuff and say, hey, look, the cyclical stuff is working. The sectors you want to lead are leading, and that's healthy. So how do you square those things?
Well, I do think there's increasing concentration, which you often see later in a bull market, going into a limited number of popular names, particularly the technology names. I know that among the top quintile performers in the S&P 500 in the last year, if you just move Amazon and Netflix to technology, they account for almost 60% of the winner's portfolio, if you will, in the last year. And at the top of the .com, they accounted for about 68% of in the trailing year. So it's fairly concentrated performance. I think, Mike, one of the big things as we look into the second half, we've been dealing really since the presidential election with rising confidence, big rise in confidence, big rise in earnings expectations, accelerating growth here and globally. And we've been doing that at a time when inflation has picked up, when cost push pressures have picked up, when the Fed has had to raise rates, when bond yields have backed up. So far, that's been a stalemate. If you look into the second half, now that confidence is already high, that earnings are already high, that growth is already expected to be pretty good, I doubt that we're going to get a lot more positive surprises on that front. But what we may continue to get is continued cost push, inflation, and interest rate pressures. And if we now have no positive surprises, but we still have the same pressures, it might get more difficult for the market here in the second half. I'm still, as you say, a little cautious. Okay. I don't really see a bear market, but I think it could be a struggle through year end.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.